to the advisory now, and there was a bit of a party going on, I understand, this week, the SMSF Association National Conference. Let's get the inside scoop. Liam Shorte is joining us from SONAS Wealth. Liam, is it a wild party at the SMSF Association annual shindig?
Well, it ended last Friday, but yes, it was a long week of very technical stuff, so I really relaxed over the weekend because my brain was blown. The big topics were basically the Division 296, which has come in, and the problems with trying to look at alternatives there. I think there's a lot of confusion out there. People still think that it's an extra 15% tax on all the earnings of your super if you've got a balance over 3 million. The truth is it's only an extra 15% on the portion of the earnings attributable to the balance over 3 million. So if you had a balance of 4 million, only 25% of the earnings would be taxed at the extra 15%. But it makes it really difficult for people to look at alternatives and to try and figure out what's right for them, whether to leave money in super, take it out of super into their own name, take it out into a company or a trust name. So it was really good to get all 1,200 SMSF specialists together and try and work through some of those strategies last week. It was really good.
Yeah.
No,
I was going to say,
one of the other things that came out of it.
Please tell us.
So one of the other things that came out of it is that people need to be aware that it's not just the ones over 3 million that need to be considering this tax. As part of the tax, the government is going to let people have the option to look at the cost base of their assets on the 1st of July this year, 2026, and set that as the future cost base for any Division 296 taxes. The problem is it's an all-in or nothing. But so people who don't have 3 million now, but may have 3 million in the future, or the reason we're calling this the grandma's tax is if a spouse passes away, somebody who has much less than 3 million now may end up with more than 3 million and hit with this tax. So they need to consider whether they're going to accept this Division 296 cost base at the 1st of July 26, even though it may be 10, 15 years down the track before it affects them. So lots of things to think about. And some other things that came out of the conference itself was we had a workshop on elder abuse, elder financial abuse. It's becoming a really troublesome area. And to be honest, it came out of it that you really need to pick who your powers of attorney are going to be very carefully, because it is difficult for your advisors, your lawyer, your accountant, or your financial planner to argue with somebody who's got a valid enduring power of attorney on your behalf. So don't worry so much about who the executors of your will be, because you'll be dead. But really, really carefully pick who's going to manage your money when you can no longer manage it yourself.
So really big issues being worked through at that conference. What about CGT? How has that been factoring into the conversation, or was it considered? I know that there's still a lot of unknowns, but yet, really important for many.
Well, the good thing that came out of this Division 296 2.0 was that the government stepped away from taxing unrealized gains. That was always going to be the most contentious issue possible. So no longer will unrealized gains be taxed, but there will be things that will affect it, like the fact that they're now going to test for Division 296 based on your balance at the start of the year and at the end of the year. So somebody who dies early in the year, they're still going to be affected by the Division 296 through their estate, and also their reversionary pensioner will be affected. So a lot of advisors used reversionary pensions to give the surviving spouse 12 months to get themselves organized and to be able to organize their finances before accepting the pension across. Now with this Division 296, it'll be a penalty if you use that, because it affects your total super balance straight away for the Division 296 tax. So any capital gains just during that year are probably going to affect both the deceased person's estate and also the reversionary pensioners. So we've got a lot of strategies to work on that. But the good thing is unrealized capital gains are not being considered for the Division 296 tax.
You mentioned pensions there. Isn't the age pension lifting for singles?
Yes, for singles and couples. So it's going up on I think it's the 20th of March. So that's a good move. We're going to basically see about $20 extra for $22 for a single person and a combined couple will get about $33 extra as well. The problem is for those who are part pensioners and based on their assets, they've got a reduced pension, the deeming rate is also going back up. It was frozen during COVID and left that way for a long time. They put it up a 0.5% last year. Now they're putting it up another 0.5% on the 20th of March. So basically your initial 62,000 for an individual and 106,000 for a couple will be deemed at a 0.5% extra. And then for any money you have above that or any assets you have above that, you're looking at it being deemed at 3.25% now instead of 2.75. So it just means that they're giving with one, the pension is going up, but taking away with another for power pensioners, that they may get less pension. And those from the Commonwealth Seniors Healthcare Card may find now that the income test, because of the new deeming, knocks them out of being able to have the Commonwealth Seniors Healthcare Card going forward.